right, we're live.
All right. Good morning, everybody. Good morning to you, Johnny Walkup.
Good morning. Noah, where are you?
Let's just start with that. Is this a philosophical question? Where am I?
I mean, it is in general. I always like to have that in the back of my mind kicking around. But I'm just physically, your corporal being, where is that?
I am in a hotel in Delray, and if I open the windows, it looks like this.
Let there be light.
So I got to shut the windows here. But I am in not so sunny Florida today, here for the week. So thank you for asking that, John, because if there are any internet issues right now or blurry images or anything like that, I start doing one of those max head drone things where I'm freezing. It's because I'm on a mobile hotspot, John. The hotel Wi-Fi does not work and connect. In this
shocking, a bad hotel Wi-Fi.
But
I imagine if you pay, $50, it might just magically solve itself. One of those
probably.
Things. Like, oh, yeah.
It's one of those things. Yeah. So I apologize to you guys if anything's bad from a bandwidth perspective, but we're gonna be short and sweet today, John. We're gonna get right to what we need to get to. I don't have a lot of slides up. We might be over in 15-20 minutes unless you guys want to talk. So you ready? Let's rock and roll.
I'm ready. Let's go.
Okay. All right. Good morning, everybody. Again, that is John. I am Noah. We are both with UrbanDigs, and it is Monday. So you're going to get a little macro Monday coming right at you. For those of you that are new to the show, we're going to start out with Manhattan real estate, take a look at how we're doing on the 30-day monthly trends, everything you need to know. We're then going to go into some macro topics. We'll look at credit spreads. We'll look at the Fed fund futures. We'll look at mortgage rates. We'll look at a couple of macro charts, and then we'll circle back to Manhattan real estate to end it up. And we're going to try to do this in 30 minutes. Actually, today, probably 20 minutes or less. Everything we discuss on this show is not financial advice. So please don't start day trading this stuff. Okay?
Good idea.
Good with the intro, Johnny? Did I miss anything?
Perfect.
Okay.
No.
All right, guys. Good. If you guys have questions, put it in the thing. Ask now or forever hold your peace. Okay. I want to start with the ticker. We're on the market snapshot right over here. We're on the 1 month ticker. Look, I even outlined this right here so you can see what I'm looking at. We're looking at 30-day supply, 30-day deal activity. What you guys need to know is this supply. I'm going to check my notes right here. This supply is supposed to end November at 991. We're at 1162. My guess is this is coming in light. Even though we're above the average right now, you can see it's on a downtrend. Look at that, minus 38%. So I expect that the supply number is going to probably come in below its seasonal average of 991 before all is said and done and November is done, Johnny.
Yeah, I would agree with that. I mean, both, usually November starts high supply, finishes low supply. And that's just a seasonality effect.
Exactly. And you can see the daily bars over here. You can watch this to see what's going on. Now, for contract signed, this is interesting, guys. We're supposed to end the month at 850. We're at 969, and we're above trend. And the question would typically be is that we're falling now. This is the time of year that this starts declining. And if you go to the 1 week, we're still doing about 240, 230, 250 contracts signed a week. That's pretty strong for this time of year. So from my seat right here, it looks like supply is coming in light, all right, for the month, and contract activity is going to be above for the month, which, okay, wait for it. If I go to monthly contract activity in my UrbanDigs chart room, 3 years, I love this chart because it's very seasonally perspectable, Johnny, relationable, whatever you want to talk about. This is contract activity by the month that we produced over the last 3 years. This orange line, Johnny, is where we're supposed to be. And we've already had the best 2 consecutive months of outperformance since 2022. The only other time we were doing somewhat okay was last fall. We had 3 months, but it was barely above the average. So if we get there again, it would be the 3rd month. Just saying.
Yeah, I almost don't even want to celebrate yet. I just want to keep the cork and the champagne until we get to that 3rd month or 4th month, whatever it might be. So as long as we can put together a decent season, I'll be happy. But it's shaping up nicely right now.
Yeah, and if you look at this liquidity chart at the bottom, guys, like, I mean, we're talking bullish because the last 3-4 months was really not that, anything super exciting, right? It's just blah. But this is actually the most active market I see right now, and we're kind of at the top of the neutral zone. So we put deal activity into perspective. Is it really high? No, it is not really high. If it was really high, this 969 would be at 1400. Okay, but this is like the best that we've seen so far this season. That's what I'm saying. So this is peak moment in time. Take advantage of it. Pull those price reductions forward because you only got a couple weeks most likely left. Okay. Okay. Questions, Johnny? Anyone?
Nope. All good.
Bueller? Okay. We pivot?
Let's pivot.
Let's pivot. Credit spreads, guys. Credit spreads. Credit spreads are our canary in the coal mine. We look at credit spreads. Let me just click the max chart here, and I'll get back to the 6-month, guys. We look at credit spreads because if it goes up, if this little indicator here goes to the right, credit stress in the internal economic system across the globe is rising. Banks may start cutting back on lending. Stocks may go into risk off mode and things might change. That's when this is going up. Look at the great financial crisis. Look at the pandemic. Look at where we are now. It's low. You take a look at the 6-month trend, take a look. We're bumping up. We're bumping up. Just to put it into perspective, 1 year, look at where we are in the 1 year. Okay. That was the tariff move right there. So credit spreads are rising, Johnny. We're at 2.1. I think the last time we had Macro Monday, we were at 1.6, a lower stage. So we did go up a little bit. The question is, does it continue?
Yeah, that's a great point. So if you look back at the peak of the tariff announcement to where we are now, that's definitely a downtrend, but we're in danger of breaking that downtrend. And what that means essentially is, the era of, that search for yield, whatever it's going to find, could be whatever we are now, that bull market that just like, give me something back for my money. I don't care about safety kind of thing. Could be easing a little bit. That might pull some valuations down. That might actually boost rates when you think about it, because that means a little bit more of a flight to safety. So we'll see how that plays out. But right now it could be, see how that goes.
Well, it's interesting to see that about rates, because I wouldn't be surprised if interest rates is what causes credit spreads to go up and maybe stocks to go down at some point in the future. We're going to talk about that. But if this starts going up, guys, to stage 2.2 to 2.3, we designed this. John and I built this. We designed it so that you really want to see 2 or 3 moves, okay, for a signal. We got one. So again, I'm waiting to see where this goes, and then you'll probably see something going on with the stock market if that happens. Report on that each Monday. Something to keep your eyes on. Okay. Questions? Are we good?
Well, we sort of buried the lead earlier when we were talking about Manhattan, and Kara pointed it out that I wonder if you can tell if the election had an impact this week. So we've written extensively about the idea that Manhattan has been really moves off macroeconomic, and generally speaking, it has its own cycle, in which case the politics certainly play into it, but at a much lower extent. So, when we're looking at these numbers, and I think we talked about this back in September, even October, yes, we have this big election coming up. Yes, we have an understanding of who's going to win. No, buyers don't seem to really care right now. The only counterfactual would be that, well, had someone else won the election, maybe we see a lot higher volume, but that's not really a road I want to go down. So look, we've posted a couple of weeks, or 2 months rather, back to back of, over seasonal gains in terms of contract activity. I think that speaks pretty well to the understanding of buyers get the political situation. They're looking forward to it. They're now buying an asset that's probably going to be lasting them for 10 years or so, and they're comfortable with it. So, be that as it may, let's go forward.
The sales market didn't do much in a long time, right? There are some deals out there. There are some pockets of people that are hitting some bids out there. And what this deal action, what this deal volume does not tell us is why are people selling? Like, what's the scenarios behind all of this? We don't know that. And it also doesn't tell us price discovery, guys. We don't know where those bids are. We don't know where these contracts are signed that we're seeing here. We got to wait 3 months, right? 3-4 months. So it'll be really interesting to see what the listing discount was when we come back and we see all these sales, and we go back to pre-election and post-election, what the discount from ask is there any bump up? Is there any bump down? Is there fear in what's going on right now? Or is it just demand coming in and it's a strong market, right? We don't know. We don't know what's going on. So it's going to be really interesting to analyze this. It's just too soon. Just too soon. We got to wait for it to close. Okay. Keep the questions coming, guys. I'm just going to move on with this little show here. FedWatch rates. Okay, guys, this is the Fed Fund Futures. Let me scroll up right here. Fed Fund Futures. This is the market, the bond market's expectations on what the Fed will be doing in its decision meetings in the future. Look at the meeting dates over here. Look at that. It's going all the way to 2027. Okay. John, what's the two rules for FedWatch table? What are the two rules we have to tell people to abide by here? Little quiz.
Well, I mean, you only want I only look at the most recent. I only look at the most recent one, but it's interesting. Just before I jump into that, I actually want to address 2 meetings. I actually want to address Karen's question. What do you think triggered the increase in credit spreads this week? And it's interesting because, Karen, if you look at this table, you can see that percentage of the market's perception of what that December rate is going to be has actually it's moving closer to flat. So yeah, it's still penciling in a rate cut, but that rate cut has gone from 80% to 70%. Now we're at 60%.
Higher. It was at 90%. It was like 89% at one point.
Yeah. And now it's at 60-ish.
That's what it is.
So yeah, that's what's coming down to it. It's still on the table, but might not happen is what the market.
This is what people
definitely push up credit spreads.
Yeah, this is what people like. It's hard to people to understand the concept of this. Like this decision right here. This is December 12th, right? We're not there. This is a future decision. And this was 90%, give or take, 90% a couple of weeks ago. And the fact that it went from 90% to 63% means mortgage rates went up. You could see it right here. Look at this. See that? Mortgage rates are going up and down based on this table, guys. And the fact you don't need a cut or no cut. It's just the expectation and the confidence in the future cut. And if that confidence goes down, mortgage rates go up and credit spreads might start widening a little bit. And that's what I'm saying to you guys, like be on the lookout that if credit spreads widen or if stocks go down, it could be because interest rates and rates in general are not going down as much as the market expects. Like look at this for a second, guys. This market expects, first off, we are here. Okay. So you know where we're at, right? This market expects a cut 63% in December, a cut in April, a cut in July. This is 2026. And I don't know what this thing is right here. That's just a statistical anomaly. I'm not even looking at that. So you got 1, 2, 3 cuts. What happens? What happens if we come back here at a later time and this whole thing shifts to the right and there's only 2 cuts? And then what if that shifts to the right? There's only 1 cut. Rates are going to go up. That's what's going to happen without the Fed doing a damn thing. So keep in mind, the bond market moves in between meetings. 2 cardinal rules, okay? Don't go past 2 meetings out, guys. This is the forbidden zone. All this is crap. It's all crap. Okay, guys? That's rule number 1. Rule number 2, let me get rid of that. Rule number 2 is if this starts declining, like below 65, 70%, then my confidence in that cut is going way down. I don't even know if we get this cut. John.
Exactly.
36% chance, no cut.
Yeah. And I think that's exactly what the bond market's thinking, which is, okay, we're not quite sure if this cut's going to happen, in which case we've got to reprice.
Yeah. And you may not get a cut here, and this might bump up to like 70%. They may push the cut back a month. So keep an eye on that. In terms of rates, I mean, look at the move down we did. Let's just look at that. Rates, like in general, are a much better place, but we're kind of coming up off those lows. That's what I see with rates.
Yeah, I'm thinking that we're still in this downtrend. I mean, it's starting to look a little weaker. That being said, look, keep my fingers
still
crossed.
low though. It's relative. Yeah. I mean, it's still good. I think buyers are getting good rates, but it could go up from here. This is a notable move down. So expect some regression. Yeah. Okay. No questions? We good?
All good.
Sweet. Sorry, guys. I can't see the screen, so I have no idea what's going on. A couple of macro charts, guys. This is basically what you need to know. There is a battle between higher inflation, stickier inflation. Inflation came down a lot, but we're still above that so-called Fed target of 2% with a lot of inflation figures. We're closer to that 3% level. A lot of people are thinking in their heads, maybe the Fed's going to go to a 3% target at some point. So that's going on. At the same time, on the other side, the unemployment, okay, the jobs market, okay, the unemployment is slowly creeping higher. So this is why the Fed may not cut, may cut. We don't know. It's whether or not the jobs market starts to get worse before inflation. But these two things are a tug of war. And that's why this is so hard to predict. Okay, guys, that's the basic of what you need to know.
Yeah. Plus, if we get a resolution to the shutdown, there's going to be a huge data deluge. So whether or not they can get it in time for the meeting is going to be up for grabs. But yeah, well, it's an interesting one because usually the Fed loves to have that data, and they might not have had it at least for a couple months. So we'll see if they can get it in time and how that's going to affect things, because that's just another open book right there.
Yeah, that's going to be interesting. Yeah, so we'll see how that plays out. That's the only macroeconomic. Oh, what did I do here? That's the only macroeconomic chart I have for you today. We don't have that many charts today, guys. This might be a short 20 minutes. We might be out here, but I thought this was really interesting. This is a national new construction measure. New construction. It's looking at the premium that new construction had over resale. Look at it. It's just about to break below resale. So basically what's going on is nationwide, the sales slump, the volume, it's not just us, guys. It's housing outside of us, right? That's seeing a housing slump for like 3-4 years now. And new construction, these new builds, they're giving incentives, big time incentives, rate buy downs, all these other things that the premium is starting to shrink. It's almost no premium. So like, again, structurally, this market is so different than what it's been for so long, for decades, that the shape and form of any downturn in this housing market is going to be very different than what we're used to seeing. So it's an interesting thing going on, even with our own little bubble in Manhattan.
Well, Manhattan and Brooklyn, because you think about
Brooklyn,
the difference between new dev and resale, even in all the boroughs, there is still a pretty nice premium attached to brand new developments in the city, simply because the land costs so much. It costs so much to build these things, and so you're the first person to live in it, kind of thing. So there's always that premium. But yeah, looking at the national level, the idea that that premium is ebbing is really interesting, and it shows the dichotomy between what's happening here in our little island off the coast of America and actually in America.
Yeah, there are some housing markets that are down 20-25% in the last 2 years. And it's hard to fathom that when you think about what's going on with our market. I think New York City is, we're in our own little thing going on. We got a lot of local policies, local things going on that are impacting our markets. But at some point, I have a feeling it's going to be the last one into this downturn, and it might be the first one out when it eventually turns around. But I don't know when that's going to be. Might be another year or two. So I thought that was another thing I thought that was really interesting. I did not know this. It's changed so much. Remember we talked about, John, like how many years people hold on to their homes. And we talked about, like, for the longest time, it was 6, 7, right? It's now like 12 or 13. Well, the median age of U.S. home buyers over the last 4 decades, look at the black line, 59. 59. The average age of a first-time buyer is 40. 40 now. Repeat buyers are at 62. Over the last 20 years, like, this is just, look at the black line in the year 2005. It was at 39. Now it's at 59.
Yeah.
It's just, again, structurally, it's crazy.
Yeah, it really goes hand in hand too with what mortgage rates are doing. And of course, with the talk of now the 50-year mortgage, I'm not quite sure how that's actually going to work out. I don't know. I don't know what
Japan tried that. Yeah. It didn't work out well.
Yeah, I don't know. That is. You want to talk about interesting bond math? You think 50 years in terms of duration is a long time. So that's you would be swinging around wildly. So I'm not sure who would want to be buying those bonds, but it's an interesting concept. But basically, the idea is, you're right. I mean, that this is really, really bullish for the rental market. The idea that people are staying in rentals for a lot longer, and then they move to housing, and then they move to the sales market, in which case prices are pushing up. So it's I think in general, it would be better if that number was lower. I mean, that is, after all, the American dream to get in that, buy your house. But it's right now, affordability is an issue. Got to bring that down.
Yeah, don't. I feel like it's got to regress at some point, but like, what's going to cause it? I don't know. Yeah, I mean, it's also probably a function of housing prices just going up I mean, not in our market. In the last 10 years or so, our market did crap. We haven't moved anything in terms of price action, but outside of our market, the last 10, 15 years, I mean, it's up 100, 200%. Even with this recent downturn, they're still up 100% in a lot of areas over the last 10, 15 years. So interesting thing going on. That's all I got for macro charts, Johnny. That's all I got. So I told you it was going to be a quick session.
Well,
it's 11:20. Yeah, I don't have much to talk about. Yeah, short and sweet. So unless you guys have anything serious to talk about or questions that you want to send us out here, I mean, anything serious, not serious, I don't care. Actually,
quick question about market. Quick question about market pulse. Why does the market pulse show we are in deep sellers market territory? Does anyone feel this is a strong sellers market?
Okay, so let's go to the market pulse. Actually, I have it over here, the chart room over here. We'll go back here. Market pulse right over here. Generate that chart. I mean, I'm just stick with Manhattan for now, but let's read this chart, guys. So that is not strong sellers territory. So let's just. I'm going to click max. Okay, I'm going to click max. So we're going back to 2008. Okay, and let me get rid of the old drawings. All right, we're not going to play Simon today, guys. Don't worry. All right. And let's do this. Watch what I'm doing. Watch it. Wait for it. A little bit above the zero line, a little bit below the zero line. And we have ourselves, maybe next time I'll rake you. What did it do? All right, hold on. Oh, God, I don't know why it's doing that. There it is. Okay. Neutral zone.
Yeah.
Guys, so neutral zone.
I think the issue with market pulse, and this is just sort of a technical issue on UrbanDigs side, was when you look at UrbanDigs market pulse on the dashboard, when you just look at that sort of the market center dashboard, the shading basically fills the chart. So it looks like it's in the strong green area. But when you zoom out a little bit, you can understand why we're so yes, it looks like, wow. But that's a limited look. Okay. So yeah, it was, it's certainly up compared to where we've been, but it's not strong sellers market territory.
Yeah. So you know what? I guess it's hard to just create an image that fits here. I'll see if anything can get done with that for perspective, but go to the chart room, go to market pulse, and use this chart. And again, we don't have a neutral zone built in there, but if you go up from zero a little bit and down from zero a little bit, you're creating your own neutral zone. This was the last sellers market period that we had, and that was 13, 14, and 15. The only other period that it was really strong like that above that was the pandemic recovery. And that pandemic recovery felt a lot better because look where it was coming from. Imagine if it was started up here, it would have been all the way up there. Like it came from the depths of hell to get above that level. So perspective, right now, I see the market improving, but we're like neutral / seller bias. You're not a seller's market at all. You'd have to be up at this level. Okay.
Yeah. And this is one of those markets where it's not, so when you go back and you look at that market from like 13 to 17, whatever that period was.
Yeah.
The most extreme sellers market we really had, you could put anything up and you'd get buyers coming in and you'd get an offer pretty much over ask for cash. I mean, it was just that sort of market. This kind of market really it's very dependent on making sure that your value aligns with where buyers are. And if you're in that pocket, you'll see traction. But if you're overpriced or you're not aligned with renovation expectations or property type expectations or whatever it is,
you're getting
it could just be crickets.
Let me tell you, also high carry is getting penalized. There's also, again, we talked about this. There's a knowledge gap between what sellers think their renovation is that they did 10 years ago and what buyers today are perceiving the value of that renovation today. There's a complete gap right there, guys. And it's hard to reconcile that gap because they're both right. Like they're both like somewhat right. It's unfortunately the market does what the market wants, and the bids are the final answer, guys. That's all that matters. So if the buyers are penalizing it, then that's the deal. Sellers have to adapt or change.
That's exactly what Kara writes in. She basically says that, condition is huge and staging works, because you're absolutely right. You have to get over that sort of psychological hump. Like the buyer has to walk in, have that visceral reaction like, wow, this place is amazing. And they're only asking, 1.2. That's a done deal. If you walk in, it's like, wait, what? They're asking what for this? Like, it's just not going to happen. Speaking of Kara,
Yes.
thank you very much. She'd like to see that ages chart again, the median buyer ages. I don't know if you have that.
Okay, I'll get there in a second. I want to point out something while we're on this market pulse chart. Whoever asked the market pulse chart, I beg you to look at the climate index, guys. This is the temperature of the listing climate. It's a great chart. If you need a 7-day trial reload to try this out, email me, noah@urbandigs.com. I'll try to, I'm away for 5 days, but I'll try to get back to you and set you up with the trial so that you can access this or take a screenshot. Guys, look, as the bars go up, it's an easier listing climate. Look at 13, 14, 15. Look at the pandemic right over here. Look at where we are now. See, this is why you got to look at all parts of the puzzle to see the picture that's trying to make out from the data. Just because we have rising deal volume, right, and it's a strong season, does not make it a seller's market and does not make it an easy market. In fact, I could see the opposite. It's still somewhat challenging out there because this bar is closer to the blue line at the bottom than the green line at the top. And it also shows how different today is from 15 or 14. So if you got a seller that bought it in 15 or 14, and then they look at it today and they're trying to figure out how the market changed, show them this and explain how different it was back then. If you were doing business back then, you know how different it was. I don't need to tell you. You know what I'm saying?
Well, plus if they bought during that period, they probably remember like having to fight for that deal on the buy side.
Fight for the deal.
Now putting it up and just waiting for someone to walk through the door for the first open house, kind of like, wow, well, this is a different market. So, yeah.
Yeah. Kara, we love you, Kara. Here's that chart of the median age. I thought it was interesting too, Kara. I mean, these are things that no one really talks about, but that's that. It's crazy. This and the fact that people hold on to their homes for like 13 years now. That's like structurally the housing market. Again, you're trying to explain maybe to investors or buyers or that don't understand the risk. They want to talk about housing and whether or not what's going on. You can explain these types of things. There's some structural differences in the housing market today than in past. See how it affects the market.
Yeah.
That's all I got, John.
Love it.
Final
I don't have
questions?
anything. Perfect.
Anything?
No, this is nice.
There's
a nice conversation. Nice conversation going on in the chat, but I don't really see any questions there. So good stuff.
Okay, good. I'm just glad. I mean, 25, 30 minutes ago, I was freaking out that the internet would be all screwed up. So I'm just glad that this came out. This came out okay. Okay. Next week, Macro Monday, guys. Next Tuesday, designing the perfect CMA. Outside of that, we don't really have that many events, but I am working on a couple of events that's going to talk about coaching, business coaching, business productivity, coaching level stuff. Get a couple coaches on, and I'm also trying to get together a high net worth management, breaking into that whole thing from a capital perspective and from a high net worth wealth management perspective. Something very different. So we got a couple of webinars we're working on. Stay tuned.
Good stuff. All right.
Thanks, John.
Well, thank you everybody for joining us. Noah, thank you for putting this together with your handicapped internet. We do appreciate it. I know it's always tough when you're down a couple bars to get that going, but thank you.
Yeah. You're very welcome. Thank you, John Walkup. I am Noah Rosenblatt. Thank you guys for joining in. We are with UrbanDigs. It's been Macro Monday. We'll catch you guys next time. Cheers, everyone.
Thanks, everybody.